I hope everyone had a fabulous Memorial Day weekend. Lots of important news came out last week. So first up is the JOLTS job opening survey, which came in 700,000 lower than expected. That's the lowest point since April 2021. But Treasuries came down slightly off their highs and then came right back up after the jobs report on Friday. And after the Cleveland Fed spoke and said that the jobs market is still very strong and inflation is too high, which is sort of ironic since every report came back basically demonstrating that the economy's headed in the direction that the Fed's been looking for. You're going to want to stay till the end to hear my rate prediction, but the US economy added 187,000 jobs, which is slightly higher than predicted. Numbers are steadily going down compared to the last 2 years of growth, not to mention that they may be revised like every other month this year. Yep, that's right. They actually revised the jobs report down. So basically you can take 25,000 jobs off of the jobs report for every single month this year, meaning that this resilient jobs economy is not quite as resilient as they originally thought. So that said, apparently there's a chance that the August jobs could be revised up because this has been a trend for the month of August over the last decade or so due to seasonality calculations, which is sort of a mystery. But one thing that isn't being highlighted in this figure, which I think is actually pretty significant, is that over the last 2 months, we've lost 670,000 full-time jobs and added just over 1 million part-time jobs. So the only reason we haven't seen job losses over the last 2 months is because part-time jobs surged dramatically. Does that sound like the most resilient labor market in the history of the universe? Not only that, there's a thing called the quits report that basically tracks how many people are quitting their jobs, and that figures down to pre-pandemic lows, meaning that people are less confident in quitting their job so they can go land the job they really want. And that number is likely to continue to drop. Unemployment is also up at 3.8% from 3.5% in July, which isn't huge, but it's also not insignificant. Wage growth also seems to be moderating, with average hourly earnings up just 0.2% compared to 0.4% in July. That also brings the annual pace down to 4.3% from 4.4%. Payrolls are also showing a steady decline as well. Overall, August data is in line with what the Fed's been looking to see. Job gains are good, but not unsustainable. Wages are healthy, but not red hot. And more people are either working or looking for work. This all basically means that the market's feeling confident that the Fed won't hike rates this month. In fact, investors are pricing in a 6% chance of a rate hike later this month, which is down from 12% last week. But there's a 35% probability of a hike in November, which is actually down from over 60% a few weeks ago. So generally speaking, the market feels like the Fed is done hiking. Even though the Fed is still talking tough, here's my opinion on why he's still doing that. Because he's saying, the job market's still resilient, all this talk about potentially raising rates, and we'll see what the data does. He's not committed to the fact that he's dropping rates. So here, the few reasons I think is they're overdoing it, like they always do. Also, it's better to talk tough and not hike than to say that you're pausing and then end up hiking. And the last one is they're driving inflation to 2% to avoid repeating the mistake of the 1970s. So they definitely want to make sure that they kill any inflation expectations. We'll get one more inflation reading before the next Fed meeting, and there's a possibility the number could come in higher than expected. But so far, the Fed seems intent on keeping rates higher for long. Now, I've talked about why credit will continue to be tight because of the new rules that will be coming into play for the many, many regional banks. That's called the Basel III Endgame. And I was talking to some of my bankers last week, and the general consensus is that it may take a few years to fully resolve. The reason being is that the Federal Reserve has proposed new rules that would require banks to significantly increase their capital requirements. The too big to fail banks would have to increase their capital requirements by 19%. Then smaller banks would have to increase their capital by 5 to 10%, depending on the size. Not only that, but smaller banks will also be subjected to more reporting requirements, so they're going to have to hire staff and implement processes and procedures to be able to comply. This is a huge task for banks. This is part of the reason why lending is tough. It's not the full picture, but it's adding to the stress that banks are already feeling. So if this passes, these rules won't go into effect until 2028, but between dealing with all of the risk of the CRE loans coming due and preparing for the new requirements, banks have a lot of work to do. And as we all know, Banks aren't a fan of risk. They don't like to take risks. So finally, this topic that I've been asked at every party, on every vacation, and at every event, what do I think rates are going to do? I wish I could tell you that I could see the future, but I can't. But what I can do is look back on past data versus the Fed language and tell you that, as I keep saying, they have a reputation for taking it too far, which means they usually have to start cutting sooner than they say. So here's a chart showing the Fed's own prediction of interest rates. Let's focus on the 10-year and even the Fed funds rate. Now, we can all agree that the Fed's starting to see the economy slowing down, which is what they wanted, and we're getting awfully close to that 2% inflation number they were looking for. Job openings are finally going down too. So today's rates for multifamily are around 6.5%. So if you came to me for a multifamily loan, that's what I'm going to quote you, more than likely. But once we see jobless claims hit at least 300,000 for 4 weeks straight, along with all the other data that's continuing to show signs of slowing, the Fed's going to start feeling more pressure and concerns about a recession, and they're going to have to start cutting. So let's not forget that 2024 is also an election year. My prediction is, well, it could be 6 to 12 months out. So in the next 6 to 12 months, it's going to be a bumpy ride with Treasuries taking some big swings up and down. But this is something for you to chew on and maybe even hold against me later on. So I see rates for commercial real estate landing somewhere between the 4.5% to 5% range. We're also working on trying to get some cool charts to show you how we came to this prediction, but it's basically a combination of the Fed's predictions in past cycles versus what actually happened. Other than that, this week is a pretty quiet week for economic data. So watch some football, go on a vacation, try to buy some deals, but have a great week, everyone. I do appreciate all your support, and I hope you enjoy the economic data and all of our predictions that we've been giving every week for a while now. So if there's anything else that you want to see, any questions that you have, you know where to find me.